With massive layoffs in nearly every sector, weakness in manufacturing, car sales, and housing, and the biggest one-month decline in the trade deficit since the financial crisis, the economic picture is not looking good, which might explain why so many billionaires are loading up on gold, including hedge fund manager John Paulson and real estate mogul Sam Zell. Bottom line, now is the time to own gold, which is why the experts at Stansberry Research just stepped forward with a major gold prediction, arguing gold could soar as high as $3,000 by the end of the year, possibly even higher. You can find out why and get instant access to their #1 gold investment today. It's not bullion, an ETF, or a mining stock, but in the past, this gold strategy could have made you nearly 50x your money. Considering how quickly the price of gold has been moving in recent weeks, you don't want to waste any time missing out on the gains these experts believe are in store for this gold stock. To get a copy of his new free report with all the details, simply go to goldmaniareport.com. Again, that's goldmaniareport.com for a free copy of his new report. Hi, this is Daniela Cambone. Welcome back to the Daniela Cambone Show here on Stansberry Research. And with me today, catching up ahead of the Fed, is Rick Rule of Rule Investment Media. He joins us from Vancouver, where he's attending the Vancouver Resource Investment Conference. Wish I could be there. Rick, good to see you. How's Vancouver?
Daniela, I wish you could be here too. It was a great conference. It's beginning to snow very lightly here in Vancouver, but the weather was very nice. The city was showing off for the conference. The conference was very well attended, and I think there was a lot of great presentations. I think the attendees came away thinking that they got their time's worth.
So a good sign for commodities, perhaps, Rick. We're seeing that uptick in folks coming out again.
Well, certainly an uptick in measurement. In interest and attendance. I think too, Daniela, you'll notice anecdotal signs that the natural resource equities market is opening up again. The cash window is opening up. Financings are getting done. They're getting oversubscribed. Yep. So interest does seem to be returning to the space, despite the choppiness in major markets.
And I'm going to talk a little bit about that with you later on, because you have a silver boot camp coming up. Stay tuned to the end of the interview. I'll talk about that. First on the agenda, Rick, I want to talk about the Fed's next steps. You know, I love having you on so you could kind of guide us. And the last time you were on, you said, look, the Fed will likely chicken out of their current projected tightening cycle. We're speaking, like I said, ahead of their decision, where they're widely expected to have a 25% rate hike here. What's your take on where they go from here? Are they going to get that soft landing they so want?
I have to say, Daniela, I've been very positively surprised by the strength of the U.S. economy in the face of fairly consistent interest rate raises. And I think the interest rate raises are the right policy if you believe in policy at all. It would appear that although inflation is softening, inflation is still problematic. The government's own numbers suggest that the U.S. dollar continues to deteriorate at 7% compounded. So from their point of view, I think they need to raise interest rates again. I think they can raise interest rates again, and so I think they will raise interest rates again. My gut tells me what the consensus is, which is to say 25 basis points. I would caution your listeners that the economic response to public policy often lags, which is to say it may be that we have not yet felt the hard punch of the interest rate rises. You will note, as an example, that higher mortgage costs have slowed down sales of existing homes and really slowed down new home construction, but the prices haven't fallen yet. My memory of prior interest rate rises is that it often takes a while. There's often a lag for the effect of policy to be felt on the economy. So time will tell through the balance of 2023 what the Fed will do and should do with the impact of this interest rate rise on the broad economy. Certain problems around the world have already been felt. I draw your attention 7 or 8 weeks ago to the real perturbations that you saw in the gilt market in London, where the rising interest rate lowered the capitalized value of long-term bonds at the same time that the hedge funds that were playing the long bond, funding it with overnight funds, ran out of money. We aren't out of the woods yet, but I have to say, Daniela, the U.S. economy has really surprised me with its strength in the face of interest rate rises. So perhaps the big thinkers can organize a soft landing. I personally don't believe that because in 50 years of watching, I've never seen it occur.
Okay, I was getting worried for a second. I said, wait a second. Okay, to your point about the lag effect, would you go on the record and say, speaking specifically regarding housing, that we would see a housing crash? I mean, we're seeing it in pockets, certain cities in the U.S., but would you say that it would be a crash?
I would be very cautious about speculating in real estate, particularly over leveraged. The fact is that in the course of my lifetime, the expected down payment on a house has fallen by 2/3, which is to say that the reliance on leverage has increased an awful lot. I am nervous, too, about the proliferation of adjustable rate mortgages that were sold 3 or 4 years ago when capital was cheap. I think a crash might be too strong a word, but I suspect that the market clearing price of real estate right now is probably 15 or 20% below the ask. If you don't have to buy or sell, that doesn't feel like a crash. But if you do have to sell, 20% below what you were expecting to sell for might indeed be a crash. Understand that the 30-year fixed mortgage rate, which is, from my point of view, the prudent borrowing product for homeowners, has increased in terms of interest expense by half, or let's put it differently, it's doubled in the 2-year time frame, which substantially reduces affordability, particularly for first-time home buyers. Where you're seeing a crash now, I think, is in new home construction, in starts. But I suspect as the interest rate continues to go up, that the price of single-family residential real estate will decline. What's happened right now is that the bids have fallen, the asks have stayed the same, and so there's no volume whatsoever. The gap between the bid and the ask has broadened. And in my experience, in the face of higher interest rates, that gap gets closed to the downside.
When we talk about housing, there's one thing that I always keep in mind that you told me that stuck with me when I asked you, well, is it a good time to buy a house? And, with no gender bias inserted here, you said, it depends. Like women buy homes for different reasons than men do. And I think that's a very valid point because I have this argument with my husband on a daily basis. But, if someone was looking to buy a home now, would you say, no way?
I wouldn't. I think it depends on your own circumstance. I suspect, Daniela, that the listenership to Daniela Cambone and Stansberry is at a higher demographic. I know that a substantial number of people are able to buy real estate for cash. And to the extent that affordability becomes less of an issue, remember that housing is also a home or shelter. And to the extent that you see something that's going to suit your purpose for 20 or 30 years, perhaps you worry about near-term perturbations in price. I was talking about the first-time homeowner who maybe will or maybe won't be able to afford their home, or the legions of speculators who enjoyed a 40-year period of continually declining interest rates and enjoyed the boom of baby boomer demographics coming into housing. I think those two parties are over, at least for a while. And I think that the marginal buyer of housing will certainly be impacted by higher interest rates. For your audience, an upper income, an upper net worth audience, right, more sophisticated audience, they get to look at real estate differently than other people do.
Correct. Yeah, very valid point. Also want to bring up inflation because we all know the game plan with the higher interest rates was to battle inflation. They're getting it. We're seeing the CPI numbers come down, but like you keep telling us, and rightfully so, inflation is not going away. And I would think if you speak to everyday people, they would say, okay, great, the numbers are coming down, but we're not feeling it yet. Is there also a lag effect there, or what's your latest take on inflation?
I believe that some forms of inflation are going to abate. I believe that stable real estate prices may lower rents in some markets. I believe that energy costs will begin to moderate in the near term simply because they went so high. Markets work. It has nothing to do with Biden's brilliance jawboning the oil companies. It has to do with the fact that supply and demand are adjusting price. So I think that energy prices will begin to moderate. But I would note, as an example, that real inflation isn't necessarily measured by the CPI. Many of your listeners, Daniela, won't remember that taxation, which is to say the cost of government, isn't included in the CPI. And the cost of government will continue to go up. Now, I guess I wouldn't complain so much about the index if I didn't have to pay the tax. But I, along with the rest of your listeners, will find that their total cost of living, when you include as an example increased taxation and stubbornly high prices for goods and services, may find inflation to continue to go up. The second thing, Daniela, that I would note, and please remember I'm no economist, is that we've had very modest wage and salary increases in the last 3 years, which is to say that most workers have experienced a deterioration in their ability to afford their lifestyle. And I would suspect that you're going to see real wage pressure in 2023, 2024. The jobs market in many categories is still very tight. And the truth is that workers in those occupations have not seen wage increases that kept pace with inflation. And I think that you're going to see, very much like you saw in 1976 and 1977, very consistent and very powerful demands for increased compensation in the labor force, which will ultimately find its way into pricing.
So, and I like the point you bring up regarding, what's used to calculate CPI. I mean, if the figures are cherry-picked, I mean, where is one to really get an accurate sense of the numbers?
I think the truth is shown to us in history, Daniela. I've used this example before for your listeners, but I assume you have lots of new ones. When I was a young man, I used to stay at a place called Motel 6. It was called Motel 6 because you could get a room there for $6 a night. And as a youngster, that was right on budget for me. Not too long ago, I passed a Motel 6 in northern Washington, said Motel 6, $119 a night. Now, there's only two explanations for that, Daniela. It could be that a room at Motel 6 is now 15 times the size with much better appointments. I don't suspect that that's the cause. I haven't done recent due diligence on Motel 6, but I suspect that the fact that Motel 6 is now $119 reflects the deterioration in the purchasing price of the U.S. dollar. And I think that you need to consider evidence of inflation over time. Think about, if you're old enough, how much money you got paid in 1980. Think about what a house cost in 1980. Think about what a gallon of gas cost in 1980, and understand that the ravages of inflation are cumulative and compounding.
And I guess just to wrap this trifecta, because we spoke the interest rates, the inflation, I need to bring up recession because I've brought this up, that there's just so many confusing and differing headlines out there about, we're in a mild recession, we're in a hard recession, it's things are going to get worse, or we're out of it. It started 2 years ago. What's Rick Rule's take, and does the terminology even matter?
I don't know that the terminology matters. I have to say I've been surprised at the robustness of the American economy. My own belief, and I may be wrong, is that the 40-year cycle of robustness in the American economy was due more than anything else to declining nominal interest rates. And obviously that party's over. I personally believe that a recession in some fashion, not limited to the United States, is probable rather than merely possible. we have gone for a very long time without a meaningful economic correction. Right. And it seems to me like most of the conditions precedent for a recession are on offer. Political instability, increasing social and political discord, and in particular, increasing nominal interest rates.
Rick, I knew you were coming on and wanted to get your take on this news item that came out suggesting that we're at very high odds of war with China. This was from a leaked memo from General Mike Minahan, who wrote, "My gut tells me we will fight in 2025." Obviously my eyebrows went up when I saw that headline. I mean, could we really be at war with China in 2 years' time? Do you have any thoughts on this news?
I'm not a geopolitical thinker. My hope is, given that despite hostilities at the top level of Chinese leadership and American leadership, that on a people-to-people basis, our relationship with China continues to improve. It's worthy to note that almost a million Chinese have studied in American universities. Some have stayed and some have gone home. It's worthy to note, too, amongst all the saber rattling, that trade between China and the United States achieved its highest totals in history last year. Mm-hmm. So my hope is that the people-to-people connection between the United States and China constrains the idiotic ambitions of the big thinkers in both countries. Whose interest is a war in? Is it in the interest of the length and breadth of the Chinese worker to give up trying to improve the quality of life of their family and come fight the United States? Is it in the interest of Americans who are otherwise productively employed to put down their plows, their tools, their typewriters, their computers, pick up guns and go to war with China? Absolutely not. It's the big thinkers in both countries who somehow believe that the projection of their ego and power should compel their citizenry.
That's right.
To absolutely useless carnage.
Absolutely agree with you 1,000%, Rick. Also want to talk to you about the latest from the World Gold Council. They've put out their latest report saying that gold demand has hit a decade high in 2022. No surprise there with the central bank purchases we saw. And leading the central bank purchases, which is more interesting, I think, is Turkey is now the world's biggest buyer. Demand increased from Turkey's central banks and households. Households also rushed to buy precious metals against inflation. So thoughts from the recent figures from the World Gold Council and Turkey?
I've seen that in the market as well as hearing the releases. It is obvious that, among other things, the push by the United States to weaponize the dollar, the idea that the United States has that it can impose its value and its policies on other countries, however virtuous those values might be, has met with resistance in other countries. And I think that there's a worldwide push to look for at least bilateral mediums of exchange outside the U.S. dollar, so that people whose policies don't conform with U.S. expectation can operate in terms of exchanges outside the SWIFT banking system. The Chinese, the Brazilians, the Saudis, the Russians, the Indians, the Turks. There's a whole bunch of people in the world that have ideas that run inconsistently with U.S. policy, and they're sick of 25 years of weaponization of the U.S. dollar. The unsung truth in all of that is, as much as they might dislike us, or as much as they might distrust us, historically they dislike and distrust each other more. So the idea that, as an example, they're going to be able to form their own currency, or there's going to be substantial exchange and saving in other currencies, is probably wrong. The U.S. dollar will continue, I believe, to be the primary medium of exchange, but I suspect that you will begin to see more and more trade, bilateral trade, take place in gold. The second thing that I think you need to
amongst those BRIC nations you mentioned?
beyond the BRIC nations. Yes, the BRIC nations, but beyond the BRIC nations. The other thing you have to note is that historically those countries, would hold their reserves in U.S. treasuries, the deepest and most liquid market in the world. The Treasury put, the idea that interest rates would continue to decline so that the capitalized value of the distributions of the bond would increase, are over. People understand that. And the arithmetic around the U.S. 10-year Treasury is lousy. It favors gold. If you buy the U.S. 10-year Treasury, the government pays you 3.5% in a currency where the government itself acknowledges that the purchasing power is deteriorating by 7%. Why would the Chinese, if they're afraid of going to war with the United States, lend the United States $2 trillion with the explicit promise that they would lose 3.5% a year? It isn't even good arithmetic.
Makes a lot of sense. Just some more thoughts on the BRICS, since South Africa is hosting, the next big event, and more countries are looking to belong to the BRICS. So we obviously see them growing in power. And like you say, are they just playing nice? But you're saying that there's no trust really between any of them. So is that why the U.S. probably is not fearing it yet?
I know that there's very little trust. Not that they trust us or should trust us particularly, but the idea as an example of a common BRICS currency reminds me of a wonderful Doug Casey quote. Doug Casey described the dollar as an I owe you nothing. He described the euro as a who owes you nothing, because there were 17 backers of it. I suspect that a BRICS currency would be a no one owes you nothing. If you look at the financial stability, if you look at the balance sheet and the income statement of the nations that would be behind the BRICS currency, with the possible exception of China, and we don't know enough about their internal banking system, given its opaqueness, as out of whack as the U.S. economy is relative to the U.S. Treasury, that consolidation of countries known as the BRICS is in even worse condition. While I think they wish that they could conduct common economic policy outside the U.S. dollar zone, I don't think anybody, including themselves, believes that their currency, with their current fiscal policies, is viable.
You just made me remember another point I wanted to bring up with you, because I've seen you active on social media correcting people or trying to explain it. So I want to give you a platform here to do so. There's obviously a lot of people reading the articles that Iran, Russia are looking at, a gold-backed currency. And you wrote, in one post, please understand that this stable coin will be denominated in gold, not redeemable for gold. So if you can just explain a little bit more, Rick, about why it's important to understand the difference here.
Well, Daniela, it's hugely important. The people who are posting on media are taking at face value suggestions that there would be a central bank digital currency or some other form of electronic medium that is gold denominated, which is to say it wasn't tied to the ruble, the renminbi, or the dollar. They are mistakenly saying that it's backed by gold, which is to say that the issuer of that coin, say Russia,
right,
would have 100% backing. In other words, that the coin itself would represent physical gold. That's wrong. The proposition is a fractional reserve system. I would suggest to you that if you are the holder of such a thing, that you are an unsecured creditor of Russia or China. And I would invite you to attempt to perfect your security, which is to say, go to Moscow and try to trade your coin for physical gold. You will see the difference between backed and denominated. And thank you for the opportunity of a commercial. When we formed the Sprott Physical Gold Trust, one of the things we did was make it redeemable for gold. That is what backed means. Backed means that the medium of exchange, the synthetic medium of exchange, be it paper or electronic, is backed completely by gold. and preferably redeemable.
And I want to talk a little bit more about investment strategy, but you made me think of something else. And like I said, I knew you were coming on, and I just had Doug Casey on. And I brought up the fact that he had done a Donahue interview. I dug it up and I watched it. I knew he had done the Donahue show. I had heard of it, but I finally watched it in my research the other night. You know, the whole thing, 1 hour from 1980. And it was incredible TV, Rick. And I even told Doug, I said, you know what? If you came out with Crisis Investing today, unfortunately, I don't think any daytime show would have you on. But what struck me from that interview was that, A, I can't believe they had Doug Casey on daytime.
Right.
2, how good the questions were. Like Donahue's questions, just spot on, intelligent. But thirdly, and what I want to bring up with you, was how educated and intelligent the audience was, or I should say, interested in finance. And you know, in the 1980s, they didn't have social media. They didn't have, you know, all the information, anything you could wish for at your fingertips. Yet here they were asking very intelligent questions. Now, my audience aside, I don't know if that's, you know, what the everyday Joe cares about or thinks about, unfortunately. I don't think most people know how much money they have in their bank account. Just, you know, I think we're just living in this era of misinformation or too much information or information overload that people are just walking around like zombies, Rick.
Daniela, I believe audiences self-select. And I suspect that even in 1980, the people who were attracted to a Doug Casey interview were probably different than those who were, you know, attracted to, you know, as the stomach turns or whatever those soap operas were at the time, you know?
Right.
And I've noticed, too, on social media that audiences self-select, audiences segregate. You get more intelligent questions from audiences aggregated by better hosts or, in your case, hostesses. So I'm not sure that very much has changed. I suspect that the audience that was attracted to a Donahue interview with Doug Casey probably wasn't representative of the rank and file of the United States. Also, remember that the interview took place in 1980. And the populace by then had 10 years of experience of, let's be charitable and call them economic wobbles. The decade of the 70s was an extremely volatile time, both in terms of the social politics in the United States and also in terms of the economy. Doug Casey came on at a point in time where at least that portion of the population that had some money had come to see the relevance of his point of view.
I appreciate that context. I knew you were going to have something good to add. Okay, let me get to 2 big events I want to talk about. The first, you have a Silver Investors Bootcamp coming up on February 11th. Tell us about it. Are you uber bullish silver now, Rick Rule?
I wouldn't describe myself as uber bullish silver, but I do note that we appear to be in the early stages of the precious metals bull market. And as those markets mature, silver takes over leadership. Silver itself is the most volatile of the precious metals, and silver equities, a byproduct of silver stocks, are more volatile still. I've been the beneficiary of 3 silver bull markets in my life, and they have been extraordinary events. I'm hoping at age 70 to be the beneficiary of 1 more silver bull market. Given the fact that I have 40 years experience in the market, I'd love to share that with listeners. The Silver Investors Bootcamp takes one beyond the narrative of silver. We give people an hour and a half long explanation of the real part of the silver market, the sources, the uses, new mine supply, mine depletion, the interplay between the physical silvers market and the futures market. Then we go to the living legends. We go to people who have built multi-billion-dollar silver companies from scratch. And we find out how they did it and why those lessons are appropriate to individual investors.
I love that. Can you share some of those names?
Yeah, sure. Randy Smallwood, Ross Beatty,
Nice.
Bob Quartermain, people who built multi-billion-dollar companies from scratch. Then we go to analysts and portfolio managers who weren't attracted to silver just in the last silver squeeze, but rather have been active in the space for 25 or 30 years, experiencing in movie parlance the good, the bad, and the ugly. Like all of my investor educational products, this one comes with a full money-back guarantee. If you attend the Silver Investors Boot Camp and you think I didn't give you your money's worth, I'll give you your money back. And by the way, this video performance, virtual performance, will be available for 6 months. So if, as an example, the fact that it takes place on a Saturday interferes with your Sabbath, or if the day before Super Bowl doesn't seem like a very good time to focus 8 hours of your life on silver, you will have the advantage of being able to review this timeless advice for up to 6 months after presentation.
Sounds like a no-brainer to me. I will definitely be watching. So February 11th, Silver Investors Bootcamp. Tickets are $99. We'll throw up the URL for the folks. The other big event I want to talk about, this is super important, Rick Rule's birthday on Friday. So everyone, please join me in wishing Rick a very happy birthday, who happens to share a birthday with my husband. I always say Rick is my work husband, and then I have my real life husband. And look at that, they're born both the same day. So happy birthday to Rick.
Thank you so much, Daniela. I only wish that I could celebrate it with you and your husband.
Would be lovely. Would be lovely. So I hope I thoroughly embarrassed you now. And as always, I thank you for your wisdom, for your time, for joining us. Come back soon.
I look forward to it. I'll come back anytime that you'll have me back, ma'am.
Fantastic. Let's see what the Fed does, and you'll come back. That's it for us for now. Be sure to stay tuned to the Daniela Cambone Show for more incredible interviews, and sign up at danielacambone.com so you don't miss a beat. We'll see you soon.
Opinions expressed on this program are solely those of the contributor and do not necessarily reflect the opinions of Stansberry Research, its parent company, or affiliates.